Welcome to Best Friends in Franchising. I'm Morgan Knoller.
And I'm Catherine Allen.
If you're curious about franchising, looking to diversify your portfolio, looking for something new, we talk money, mindset, and everything in between. Let's dive in. Today we have a very special guest, Brian Gross. Welcome, Brian.
Hello, thanks for having me.
Really excited to have you here on our podcast today. Thank you so much for joining. For those of you who do not know Brian Gross, he is a franchise consultant on our Franchise Insiders team. He also has a background in wealth management and was a former Art of Drawers franchise owner who had a very successful exit. Brian, why don't you share with us and our listeners a little bit about your background and your story as it pertains to franchising?
I'm happy to. So I think I have a similar background to a lot of people that are looking to get into their first franchise. So I spent about 13 years in the corporate world, mainly in the wealth management space, in a lot of sales, business development type roles. I'd always been curious about doing my own thing, really wanted to have my own business, but never really had an idea of what to do. Spent a lot of time looking around biz buy sell, looking at existing businesses. And probably about 5, 6 years ago, I got connected with a franchise consultant. So started looking at the franchise world, and it really clicked like, hey, might be the best of both for someone like myself who has some business skills, just never really operated my own business before, looked at a lot of franchises, was scared, looked at several, walked away, spent another 2 years in the corporate world, and then decided kind of at that point I was ready to take another run at it. So I worked with a franchise consultant, looked at several brands, and then just as you mentioned earlier, bought my first franchise about 3 years ago, and that was called Art of Drawers, which is a home service franchise.
Thank you, Brian. So with that franchise, you ended up exiting. Can you kind of walk us through what did that look like when you exited? Did you have a strategy? And what made you go down that path of exiting when you did?
Yeah, that's a great question. And I did everything wrong that you possibly could. So we say, did I have a plan? That the plan did not exist. So just to give a little more color about kind of what was going on at that time. So I'd spent years living in Washington, D.C. My spouse had taken a job in Florida. So we moved down. We thought we would be there for 5 years or so. So it seemed like a great time to invest in a business, especially I was in Tampa, Florida, growing market, a lot of positive things going on for home service brands. And so I invested in this brand. My husband's job changed pretty drastically about 6 months in. And then about a year and a half in, we were looking at each other saying, hey, why are we here? And really this business was the only thing keeping us there. All of our life, new job that he had started another business as well was all back in Washington, D.C. So really it was just life that hit us that said, hey, this probably isn't the opportune time. We haven't been planning for this, but when we look at everything going on, it makes sense to sell the business at this point.
And I think you bring up such a good point. It's life happens. I mean, it does, and you can't predict it. Morgan, I mean, Steve, your husband, right? What, 2 years ago, he was, I mean, you tell the story, but is now half the month out of Memphis, and you're in California. Yeah, I mean, life happens. And so you need to pivot, you need to transition. I think that primes me for my question, which is owners should operate their business as if they're preparing to sell it. And what do you think that looks like, Brian? What does that look like in practice from day one?
That's I think some of the best advice that you can give, especially if you're a consultant, is to operate your business like you're getting ready to sell it. And I always think about that, having your business operate as smoothly as possible, really in top form. And I think there's a couple of parts to this. One, to start a business and to really scale something well, I think you have to be all in. And so maybe that first 12, 18 months looks different than what it does as we start to, go down this conversation of getting ready to sell. But I think a couple of things. One, it's really being focused on growth. To talk about having a story to tell in your business, and it's seeing that top line growth, that revenue growth year over year. But also, having a very tight control on the financials, increasing your margins, hopefully at the same time reducing some of your expenses. Um, the second aspect of that too is starting to get yourself out of the business, right? When you start to think about selling and looking for people looking for an existing business, people do not want to buy a job in general. So the more that you can start to scale yourself out, not be the one that's driving all the revenue, that's handling every issue that comes up, is really going to give you a much bigger pool of buyers when it comes to exit time.
I totally agree. And I know we were talking about this last week when we were preparing for this call. And I even asked you, I mean, for those of you listening, own a Soccer Stars franchise. I just bought my second territory. I'm a top producer in the network. I'm doing great, but I'm really still involved in the day to day, which I like. It makes me happy. And I have a manager who's pretty much full time. But we talked about that. And I said, Brian, we were talking about like what that looks like to get me more out of the business. But, most franchise contracts are 10 years. And so I'm 2.5 years in. It'll be 3 years in June. So I'm still all in and I'm happy and I'm growing it. I'm really focused, like you said, on that top line revenue. So what can I do to drive that growth through acquisition, through growing enrollment for me, new locations, but then also making sure as I get ready to, or as we're talking about, right, operating as if I'm preparing to sell, what that looks like as I would step out.
And Catherine, I think you're at the fun part now. When you think about a franchise, and one of the things you talk about is, the agreement. So you mentioned 10 years. So a lot of franchises are 10-year agreements. That can be scary. If you think about what am I doing for the next 10 years?
Yeah.
I have no idea. I hate the question, what do you want to do 5 years from now? Because,
Yeah.
I don't know. Right. So, but that's where, when you start thinking about how you're going about this, you're setting yourself up for options where you're not necessarily committing to 10 years. You might be selling in three
Right.
years or 5 years. But this is, I think, one of the cool things where if you do exactly what you just mentioned, you buy a franchise, you're all in. Because you've been all in and you're a really good operator, you're a top performer, right? So now at year 2, year 3, you're starting to make decisions, talk about running the business, not running the day to day as much of,
Right.
hey, now I know this model works. I know I'm good at it. So now you get to start thinking about things like, do I want to start approaching my neighbors and looking at rolling up, buying more units that are already up and running around me? Because
Right.
as I see, I run them better than they do. No offense if they're listening. Or you start to think about, on the flip side, hey, I want this to be in my portfolio of businesses. So now how do I start to hire and manage people to get myself out of the day to day, 40 hours a week? And,
Right.
and that's a great place to be when you start to have those options.
I like that,
I
Brian.
couldn't
And I
agree
also,
more. I love
yeah.
how you said that. Thank you.
So with people thinking about selling with these franchisees, like I definitely plan to sell at some point my business. I think a lot of people don't realize that you do sell to your neighbors and to the franchisees within your system. But what would you say, Brian, if we're talking about like private equity versus selling within the franchise system? Is there one better than the other in your mind, or does it not really matter when you're exiting?
That's a great question. And I think the whole conversation around PE, one, we've seen a lot more private equity investments into franchises and not buying a whole franchise system, buying at the actual franchisee level. So it's exciting that, this is a system that does work. And it kind of proves that franchising in general, it's not just buying yourself a job because you're starting to have some pretty big players that are interested in these businesses. But one of the things I think just gets overlooked so much in the franchise world is having other franchisees in the system, those built-in acquisition partners. And I don't think necessarily any one type of buyer is better than another, but when you're trying to sell a business, you're trying to get top dollar, you really want as many potential buyers as possible. So, if you're starting to scale a business, multiple units, and you are getting, your operation, say you have 3 to 5 plus units where you're doing that 3, 5 million plus in revenue. You have that EBIT of a million plus. You actually have an operation that's going to start catching the attention of probably private equity. If not, you're going to have independent buyers, family offices, maybe some search funds. But then you're also going to have a lot of built-in acquisition partners in your franchise system who are more comfortable, paying that multiple because they know the business, they know it works, they know they're good at it, and they're looking to expand. So the more options, the better.
I feel like that you said that so well,
Yeah.
Brian.
And I know when we were talking last week, you had been talking about, because you exited your franchise system, the advantage of being in a more established system with active buyers. I think you were one of the first, right, owners in
I
your
was one of the
system.
first franchisees in my system.
So talk to us a little bit about that and how that kind of impacted your exit strategy.
Yeah, I think that's something that really gets overlooked in the due diligence process of what is the right franchise system for me. And it's not that one's necessarily better or worse than the other,
Yep.
but the risk profile is different. And when you are in an emerging franchise, there's just a different level of risk. There might be more upside where you get bigger territories, more access to the founders and the leadership team. But at the end of the day, there's a lot that still has to be worked out. Not all smooth sailing operations behind the scene. But you also don't have, all those established franchise partners in the system that are able to buy your business. Right? When I went to sell, I was the biggest business in the system. So,
Right.
finding someone internally, no one else was ready to acquire a business that was even bigger than the one they were operating. Right. So that, for what would have been a lot of franchise systems, my first call or really my first set of buyers just wasn't even on the table for me. So it was immediately going externally. But, I'd also take this point that you bring up when you think about the risk profile. Um, at the end of the day, when you go into a franchise system, whether it's very established or emerging, and you do really well, you do it right, things get off the ground, takes off, you're profitable, you're going to have buyers out there. There's a lot of people out there looking for existing businesses today that want that cash flowing business. Where I think you really help yourself in a more established brand is really lowering the downside. So if you have a business where you get in and you really don't like it, you get in and say, actually, I hate being a business owner. I thought this is what I wanted to do, but this isn't for me, or it just doesn't take off. I'll give you an example of two different conversations I've had in the last month,
Yeah.
um, where because I work with a lot of franchisees that are looking to sell. So I work a lot with buying and selling existing franchises,
Yes,
on the
you
open
do.
market. And so fortunately, I have a lot of people that reach out looking to sell their business. And I had one that was a painting company, um, part of a great franchise system. They have over 250 units open around the country. And this particular franchise owner never left a full-time job, tried to scale the business by just hiring a manager, and it just didn't really work out. I'm not profitable, looking to sell. And so he comes to me in the first conversation is, I said, who have you talked to? Have you reached out about selling this business? And I think a little bit of embarrassment because I've told the franchisor, and I got your name and you're my first call. And I said, all right, your first thing you need to do this afternoon is go reach out to every franchise partner in your system and make it known that you're looking to sell. And so we never listed on Biz Buy Sell because it wasn't profitable. It's going to be a little bit tougher to find someone that
Yeah.
wanted this business. Um, and he's now broken. So what happened was he ended up breaking up 6 territories, selling to 2 different existing franchise owners in the system. So wasn't
Okay.
profitable. Again, not the ideal, but even when it's kind of worst case scenario, still had people that would wanted to come in, buy those territories, and he's able to exit the business.
But and that's
Where
such, I just want to
Yeah.
pause you really quick. Such the value that you offer and that we offer as as franchise consultants
Mhm.
is that advice right there. I
Yeah.
mean, you're just being able to coach him through the process of selling his business, which is, part of the bigger story. But that's just amazing that you could help him in that way,
Yeah.
because that's not easy to
And
think through
that's and
always.
that's something you probably don't really think about, right? When you're looking to invest in a franchise, because you're always planning for worst case. but it's just something I think that is a little bit peace of mind, knowing that you have a lot of people that are successful that probably will come in and, or potentially buy, if it doesn't go as planned.
And I'm also talking to a someone who owns a franchise, and he is interested in another franchise because it's not aligned with his passions anymore, his interests. He's just kind of he's doing okay. He's definitely profitable. Like he's doing well, absolutely. And he's just like, you know what? I just don't feel like the franchisor as as is as invested in the success of the franchise owners. They're more focused on international expansion, which absolutely happens. I've been in franchising 15 years and I've seen that story play out.
Yeah.
And so he's like, you know what? I'm just going to pivot. I'm going to look at right now, he's looking at some home services brands. He's more in the fitness space. And that's what I'm helping him work through. And I think just to note, one thing I love that we do as franchise consultants in our team is leveraging our Oracle assessment really identifies one, those people who are primed to be that empire builder, right? So that is when you're that empire builder, that's kind of the signal of like, okay, maybe you can build this up and exit to PE and private equity. Also, it identifies your risk tolerance of right that emerging brand versus something that's more established. So as part of our process at the Franchise Insiders, what Brian does, what I do, what Morgan does, is we're actually able to use data through an assessment we have you do to determine which franchisors and systems you're going to align with. If it's more that risk adverse personality type, that's going to be someone who's a more established brand, like a Neighborly, if we're talking home services, versus something that's more emerging. And then within that, that multi-unit empire builder. I'm going to move on to the next question. So, do you, what mistakes do owners make that unintentionally decrease the value of their business, would you say, especially around expenses, staffing, and structure?
Yeah, there's a couple of things that we see over and over when you go to sell a business. And one, it sounds silly, but this happens when you get caught up into everything that happens with owning and operating a business. But it's just simply not knowing your numbers, not being in tune with your accountant, your bookkeeper, understanding the P&L. Because at the end of the day, you start just focusing on that top line revenue. And I'm getting the next sale, getting the next customer. The more I bring in, the better off we are, and that's just not always the case.
So, Brian, what mistakes do owners make that unintentionally decrease the value of their business, especially as it pertains to expenses, staffing, marketing?
Yeah, I'm going to highlight a couple that you see over and over, especially in the franchise world. And one is just not having a thorough understanding of the numbers. So when you think about just your P&L, where you stand overall in the business, and you see so much focus just on that top line revenue, focusing on getting the next sale, getting the next customer, just assuming the more you have coming in, the better off your business is, without really keeping a tight understanding on expenses, on marketing. Those are things that creep up and end up hurting your margins. That at the end of the day, that's what your multiple, that bottom line is what that multiple is based off of. So not really protecting that final. And the second thing that see all the time is really just being too involved in the day to day. And it's a great thing early on to be all in, really doing everything it takes to get the business off the ground. But once you start to get a team in place, figuring out, especially if you're starting to think you're ready to are wanting to prepare to sell the business, try to get yourself out of the business as much as possible, really, so it's not that one key person risk, that buyers are afraid of, especially if you're the one that's making key decisions, heavily involved in the sales process that's actually bringing revenue in the door. The more you can remove yourself and just prove that the operation works without you being overly involved in the day to day is going to help the exit value.
100%. And I do want to just bring up a quick story from last week. I had someone call me from our system and just kind of reevaluating where he's at, and he's about a year in. We know a year in, you're still grinding, right? You're still in it. You're still in the business. You're still growing. It's still it's a lot going on. But when I started diving deep and asking him questions, he's like, I just, he's a lawyer by trade. He's like, it's just, I feel like, when I'm out there coaching preschool classes still, because a coach calls off, it's just the frustration of that, right? Like a year in. And I think that is really where just that when you buy your franchise, like, when I bought Soccer Stars, I bought it to I was in it at first. I was coaching 13 classes a week. I was doing all the things because I believed I need to lead by example, and I need to, how can I sell this program? How can I hire, train, retain coaches if I haven't run the classes myself? But then I needed to quickly step back to
Mhm.
work on the business, not in the business. And I feel like when you're still in the business a year in, that you're not going to be able to scale, and you're not going to be happy because that's not why you bought the business. Like most of these businesses you bought to grow a team if you have employees, if that's a part of it, and to scale up. And so I think it's just one of those things to your point of hiring and bringing a manager in. Um my next question is, you know, um you had shared a story. I just will kind of wrap up this on maximizing value about front loading expenses for tax write offs and then 3 months later realizing you were maybe going to sell. Can you walk us through that lesson? Because I think that's really
Yeah.
important. I know when you shared it with Morgan and I were like, ooh, good point.
So I was, getting back where we started, where when I sold my business, I made more mistakes than probably things I did right. And part of that came back to not having a long-term plan. Like when I went to sell, that was a pretty quick decision process. And again,
Right.
just because of things that were out of control of the business, it was just personal life. And so, at the end of the day, if you are thinking you're going to sell, that's probably a 2-year runway. Ideally, you're starting to prepare your business, the financials, the day to day, the operations, again, to maximize the value, not 3 months. And, it's kind of the funny timing of my scenario was the year before I sold, we had a huge Q4. So when I was doing my tax projections and everything I was kind of planning for the year, great problem to have, but all of a sudden I actually made a lot more money than I was expecting that year. So I get to December and I'm looking at this and, being somewhat financial savvy, I start thinking like, how do I minimize my tax bill for this year? So I start prepaying marketing expenses. I was reaching out to third-party vendors,
Doing
buying
that right
six
now.
6 months of you know different things. I was talking to our installers, anything that needed in the warehouse. I was just buying up, trying to front load all of as much expense as I could for the following year.
Right.
Great, get those expenses in December, and then comes January, come February, literally 2 months later, I'm sitting down and we're having this conversation of, hey, we're going to move, and actually I think we're going to sell the business, right? So I had my business for sale 4 months later. So when I start to look at my EBITDA, my STE for the previous year, that's where I'm really starting to base the valuation off what I'm going to price this company. So that was just an example of all these expenses that I incurred in December that didn't need to be on the books the year before, that I just front loaded to try to minimize the tax bill. So that's just, it gets back to, that's just an example of, there needs to be thought. There needs to be some time that goes into this. And even if you're not ready to sell yet, you're starting to think like you're preparing your business to sell. The sooner the better.
And you touched on valuation. What is that look like for, our people listening out there? How do you value business? What's a multiple you can expect? Can you talk to us a little bit about that?
Yeah, valuations are all over the place in the business world. This isn't a franchise versus an independent business where one's necessarily better or worse than the other. But they do, there's a wide range. You'll see a 1 to 2x of your yearly earnings on the low end, and you might see some of these bigger deals that are going up 6, 7, 8 plus times earnings. So what you typically see on the low end we're seeing businesses that are where the owner operator, they're heavily involved in the day to day. So someone more or less, they're buying themselves a job and they buy the business because they have to come in and take over the work the owner was doing, or they have to pay someone to do that. You know, so as you start to scale up, say, you know, one of the things that helps is higher profit margins and just higher revenue, and at the end of the day, higher EBITDA. So the higher that those margins are, there's more room in there to hire, to start to replace whether it's yourself or add employees. So that's going to help the valuation. The other thing that's going to help too is just more predictability. So you start to think about companies that have recurring revenue, just very predictable month over month, year over year. So think about something that's like in home services, pool cleaning, for example, or house cleaning that has that monthly, that sticky customer, versus something like painting that can have huge jobs, but they're one off, right? And they're always dependent on selling the next job to keep that revenue going. So the more predictable typically helps with the higher revenue, or the
Thank you
higher
for
valuation, I should say.
Yeah, thank you for walking us through that. That's really valuable and important for those of you who are not only looking for a franchise, but currently own a franchise and maybe listening and are thinking about, again, we're talking about always be thinking that you're going to sell. Switching over to the sale itself, structure, financing, and buyers. Can you talk to us about seller financing and how common it is in franchise resales? And what does a healthy structure look like?
Yeah, that is one that probably doesn't get talked about enough, especially in the resale market. So, that's a strategy that we see a lot in the marketplace today, both franchises and independent businesses, but sellers offering seller financing, right? At the end of the day, that's more or less just a loan from the seller to the buyer that just keeps the buyer less dependent on the bank, maybe less money that's going to be tied up in an SBA loan at a higher rate, and just more flexible terms. So at the end of the day, it can be great for the buyer. It just gives them more flexible, also keeps them from having to put so much cash up front. So more flexibility there. And then from a buyer, it can also be a great tool to continue getting paid on a monthly basis, maybe 3, 5, up to 7 years, depending on the way it's structured, and also potentially, help the seller defer some of the taxes over a few years as well.
I like that. I like that a lot. And you had mentioned deals where 50% of the purchase price was seller financed. What should sellers understand about the risks and the upsides, like earning interest over time?
At the end of the day, debt, especially from think about from the buyer standpoint, it is all debt. So you have to make sure you're factoring in those monthly payments, into the unit economics of the business that you're buying, make sure it actually does make sense. Um, but it starts to give you just, again, more options when you think about, especially in the franchise world, you start to look at seller financing for a portion of it, maybe SBA loans. We're seeing HELOCs be very, very common now, especially as residential homes have just continued to go up in value over the last 5, 6 years. And then also, the ROBs, the rollover for 401k. And what we're seeing with a lot of these deals is it's not just one of the above; it's mixing and matching, a couple of these options to get together the best deal possible.
Yeah, and I use the ROBS to finance my franchise and borrowed against my husband's 401k. And I mean, it was you can borrow up to 50,000, and I needed
Mhm.
basically 50,000, so that's what I had to get going. And Jack at the time I worked through Jack offered a rebate, which our team is offering rebates for anyone listening. We will be offering $1,000 rebate on every unit up to 5,000. So just want to throw that out there because it really helped to have just the extra cash in my pocket to put towards the building of the business and the marketing. Um,
That's such a good point right there too. And it's just you talk about every dollar matters, and
yeah,
especially when you're talking about structuring these deals and financing. It's when you're buying a business, that purchase price, that's part of it, right? Or that's the initial
right.
investment. That's part of it. And you start talking about how do I, with tax incentives, deal structuring, how do I get as much liquidity as possible to have that first 3, 6, up to 12 months where, as we talked about earlier, that's the toughest part of a business, where you have those unexpected expenses, or you want to spend a little bit more in marketing, that spend more where things that actually drive growth in the business.
Yep.
If you don't have access to the capital, you're going to be kneecapped really, really quick. So again, that's where you can't have enough thought and conversations around how to structure, investing in a business up front, because it really does affect every decision over the next 6 to 12 months as you get that business off the ground.
And you brought up a good point that made me think about, when you are going through the process of evaluating franchises, you're going to have a marketing call, so they'll go over all the marketing, but the validation calls that you will have with the franchise owners, you really want to ask those questions. Just since we're talking about on the marketing piece, what do they spend on a monthly basis of marketing? Where do they spend that? Is it digital? Is it events? Is it partner marketing? I mean, every business is different, but that's really important to understand to ensure you do have enough liquidity and capital to invest in that. Because as someone who comes from a marketing background, I very much understand the value of marketing and the importance of marketing. And you do need to have the cash to put into that, and you want to follow what the recommendation is of the franchisor. I feel like I used to sit in a marketing seat for a home care company, and it was, I don't know why, but like marketing was always something people didn't want to spend money towards. It really, and then they're like, but my business isn't growing. And so it can be, a hard pill to swallow when you're starting out. I get it. I'm a business owner. Even as a person who has a marketing background, I'm always like, ooh, do I really want to spend that on marketing? When I'm not sure what that return is going to be. And I get it, but definitely it's important, and you need to invest. You need to invest to grow the business. Okay, to close us out, and I'll answer this too. Looking back, what's one thing you wish you had known before buying your franchise, Brian?
I wish I would have put a lot more thought into what was the best franchise for me that fit my life. And I lied to myself when I was buying my first franchise, and I do differently now. And I always really try to push people I'm working with, because I lied to myself. I lied to my franchise consultant, and I was so, just laser focused on saying, I want a business that makes a lot of money. I'm I'm focused about the unit economics. I want healthy margins. I want to be able to scale. I was thinking big when I was leaving my corporate job. And the reality is, a lot of businesses make money. A lot of franchises make money. But now you really get to kind of design a business that makes sense for the life you want to live, rather than just a day-to-day job. So, I would have been, I think, a lot more honest with myself as far as what I really wanted to be involved in and day out in a business I was building.
I love that. Thank you for your honesty. I think I didn't really dive into the unit economics because numbers haven't always been my strong suit. So I think I would have liked to have understand like truly the what you understand very well, Brian, but I understood the lifestyle component. So what you I matched really well there, and everything's going great. I have no complaints, but I didn't truly understand the unit economics as well as I should have, and um, you know what the business could make. But it's like I said, it's all going just fine. But like you said, there are a lot of franchises out there that can make a lot of money, and just probably understanding that
Catherine,
future.
I think what you're saying is we have a partnership opportunity here. I'll hit the numbers. You focus on what we really want to do. I think this
Clarity.
will work
I
out
got the
well.
clarity. I got the vision. If you can handle the numbers,
you
we're
have
gonna.
you have all those marketing skills that I'm clueless
Yeah.
on. This is perfect.
And what's one thing you wish you had known before selling your business, Brian?
Um, you know, I think we talked about this, but before selling, I wish I had this advice to always kind of prepare to sell. I wish I would have just been thinking about it much, much sooner, and been more prepared, and just had, more of a plan in place. because again, it just would have made the transition easier, and it also would have helped my, what I was able to actually sell the business for.
For franchisees listening who want to build something they can both scale and exit, what is your biggest piece of advice?
My number one piece of advice in that world is talk to people who've done it. Talk to people who are doing it now. There's a lot of advice out there. There's a lot of stuff to read online. Right? There's podcasts. It's like information overload at this point, and just the business acquisition space in general, not even franchising. But talk to people who are doing what you want to do, who've invested in franchises, who are scaling them, who've potentially had the exits or setting themselves up for an exit, and get advice from people who are actually walking the walk.
Like Brian, like myself, like
Like,
Morgan. We're
like,
here. We're
like
here.
this
We're
team.
happy to talk. I swear we don't bite. Um,
And that is not a shameless plug for the franchise insiders, but I
right, but
think that's
anyone.
why,
Yeah,
that's why our whole team exists, right? Because that there's power and knowledge of just that life experience that we've all had in this space.
absolutely. Well, thank you so much for coming on today, Brian. Well, if anyone wants to learn more about any of us, and pick our brains, we're happy to talk. Like I said, like Brian mentioned, we're he exited his business successfully. He would be a great person to talk to about what that looks like, how to plan if you're looking for your next franchise. Myself, Morgan, both Soccer Stars owners on the Franchise Insiders team. Just go to thefranchiseinsiders.com. You can find information, contact information for all of us. And just want to thank you for listening in today, and look forward to talking with you next week on the Best Friends of Franchising podcast. Take care. Bye-bye, everyone.